we have the two types of accounting that we're going to be looking at, which is the lessor side and the lessee. The lessee is the user of that equipment or building that they're leasing, and the lessor is the owner. So we have to check how are we going to report that on the financial statements of both, okay? And what are the journal entries that we need to make? What are the calculations that we need in order to come up with the journal entries? And we have these periodic payments that the lessee is making to the lessor. So the lessee is going to have a payable, a liability on their balance sheet, while the lessor will have a receivable. So they're mirror images of this transaction. Okay, so you have why are they leasing? So you need to go or understand that. You also have, I believe, videos related to this chapter. So hopefully you can, or those were able to provide information regarding leases. From the lessee side, we have two types, which is the finance lease and the operating lease. From the lessor side, we have a sales type and operating lease. So sales type is subdivided into without selling for profit or selling for profit. Okay, so we can see the different journal entries when we have two different types. How do we make that determination if it's going to be a finance or sales type lease? It has to meet the five, it has to meet at least one or more of the 5 criteria that are listed here. Okay, so you kind of have to memorize this criteria. And if it doesn't fall under any of these 5 criteria, then that means that it's going to be treated as an operating lease. Okay, so the agreement specifies that the ownership of the assets transfers to the lessee. The agreement contains a purchase option that the lessee is reasonably certain to exercise. The lease of the term, or the lease term, is for the major part of the remaining economic life of the underlying asset. And usually in these type of problems that we're going to be tackling in this chapter, they do give you the economic life, so that in that way you can see whether it's a major part or not. These requirements have slightly changed. In the old days, we used to have a percentage greater than 75%, but now they're just saying major part. Okay, so that's the criteria now. And then we have to also assess the present value of the lease payments, which should equal or exceed substantial all of the fair market value. Okay. The underlying asset is of such a specialized nature that there's no alternative use. So this is, for example, when we hire someone to build a plane, okay, and then they're gonna lease it back to us. So this plane has been made or built to our specifications, and it cannot be leased to anyone else. Usually this is like military, okay, or it could be like airlines or stuff like that. Are there any questions regarding the criteria or the two types under lessee and lessor? Questions? Crickets? Okay, so I'm not going to go through the example because we're going to go over the assignments, and the assignments will be in lieu of the examples. So I'm just going to kind of, I think this is pretty much it, all I wanted to say. And so that way we'll have time to spend on the assignment. Okay. And then, of course, we come to the operating leases. Okay, so that was the two types under lessee and lessor, the operating leases. In the old rules, If they had an operating lease, they didn't have to report the liability on the balance sheet. So this was called an off balance sheet transaction, but that has changed once GAAP has converged with IFRS. And this has been for a long time very controversial. So now they are requiring that if they have an operating lease, they still have to record the liability. Okay, so it's not kept off the books anymore. However, so the lessor it has no entry when it comes to operating leases because they're not going to credit that asset. They're still holding the asset or showing the asset on the balance sheet. So that's probably the biggest difference between an operating lease and a sales type lease when it comes to the lessor, because with the sales type lease, they're gonna credit the equipment or whatever they're leasing. But when it comes to operating leases, there's no entry for that because we're not going to get rid of the asset. We're still holding the asset in our balance sheet if we're the lessor. Okay. So again, we'll revisit this again in just a few minutes as we go through the assignment. So I welcome your interactions. I don't like it when it's too quiet because I kind of feel like I'm talking to myself and then my throat starts to hurt. So is everyone okay? And does anyone have any questions? Okay, thank you, thank you. Just checking. All right, so we have our first exercise. I hope I have space here to move along. Let me just get my other. So I kind of have like a partial present value of ordinary annuity table in this case. If when you guys are doing these exercises, you can either download one from online, or what you can do also is click on the links and it will bring you to the specific table that you need to access. Okay. Whatever's easier and whatever works for you. If you want to use Excel, or you have what do you call this? A scientific calculator, and you want to use that, you're welcome to do so. That too. All right. Ooh, some of these things don't come out right. Okay. Okay, so we have American Food Services Inc. leased a packaging machine from Barton and Barton Corporation. Barton and Barton completed construction. So in this case, American Food Services is the lessor, right? Oh no, I'm sorry, from. So they're the lessee. They're the lessee, and Barton is the lessor. So they're asking us for lessees, entries, and information. So for the lessee, we have two types of leases. What are the two types under the lessee? Either a finance lease, is that what we said? Or what else? No, sales type is for the lessor. So for the lessee is called finance lease. And then what is the second option that they have? Operating, right. So if we need to determine if it's a finance lease, that means that it has to meet one of the five criteria that we had listed, right? One being that the lease term is for a major part of the economic life. Did they give us useful life was expected to be 4 years? And this lease is also for 4 years, right? So it looks like its economic life, it's equal to the term of this lease. So it meets that criteria. So that means that it's a finance lease rather than an operating lease. And so we have the lease agreement is for $6 million a year. The fair value is equal to the present value of the lease payment. So in terms of journalizing the entry for the finance lease, we need to actually use the lesser of the fair market value or the present value of lease payments. In this case, they told us that it was equal. So that's the amount that we're going to be using, the $6 million. We don't have a monthly, is this monthly? No, I'm sorry. This is yearly, right? The payments are due, when are the payments due? At the end of the year. Okay, so this is annual payments. And the payments are due at the end of the year. So we lease this machine on January 1st, but we don't have to make a payment until December 31st. So in this case, we're talking about an ordinary annuity, right? Because the payments are made at the end. So that's something that, the type of analysis that you need to make before you start doing any calculations, right? So we know it's a finance lease, check. And now we know that the payment is at the end. So we're going to be looking at present value of ordinary annuity. And so we are supposed to, number one, we're supposed to do our journal entry. And so I'm just going to do it here in this little tiny space that I have. So so this is number one. On January 1st, 2021, this is a finance lease. So what is this Lessee American Food Services going to debit and credit? What are we debiting? So once that we have made a determination that this is a finance lease, what do we debit? Right, we're using right of use asset, okay? And this is for 6 million. Oops, that should be a $sign. 6 million. And then what are we going to credit? Lease payable. Okay, so we have a long-term, well, portion of this will be long-term, a long-term liability that relates to this lease. Okay, so there we go. We have made the determination that it's a finance lease, and so we have our initial entry on January 1st for that amount. Now, if we want to proceed, now, do we know what the annual payments are? Here we are supposed to have the amortization schedule with the lease payments. So how do I know what the lease payments will be? Well, we're gonna have to take our 6 million. So for number two, first of all, we need to, in order to do the amortization schedule, we need to know what the lease payments are going to be, these annual lease payments. So we need the present value of an ordinary annuity, where N is equal to what? 4 years, okay? 4 years, and I is equal to, I know they told us, 10%, 10%. Okay, So we go to the present value of, well, first of all, we have our 6 million. Okay, that's the fair value of the lease. And we're going to divide it by our present value factor to come out to the lease payments. So we're going to go to column 10, and n is equal to 4. So the factor is 3.16987. Now you can also use the formula. If you are, more comfortable using the formula, you can go ahead and do that. Or you can use the factor, whichever is easier for you, whatever you're used to doing. 6987. So I get 1,892,822. Did you guys get the same as the lease payment? Can someone confirm that for me, please? Hello? Hello? April, thank you. All right, and so we're gonna do our amortization table. So the amortization starts on January 1st, right? We have the 6 million, that's the amount of our lease. And then there is no payment until December 31st, 2021, correct? Actually, we probably need another line here. Or here we need headings. So we have our lease payment. We have our interest expense, right? We have the decrease to the balance. So it's just like any other loan, if you think about it, right? If you have like a car loan, you'll probably use pretty much the same amortization table to figure it out what those payments are. So how do I figure out the interest expense? What's the formula for that? So the payment is fixed. The payment is not going to change. Right. So in this case, we have 6 million. Oops. Let me just 6 million in outstanding balance. And so I'm going to multiply by the 10% interest rate. So my, what do you call this? My interest expense is going to be 600,000. And I'm going to decrease this loan by the difference, which will be 1,292,000 if my math is correct. Okay, so at the end of 2021, instead of having 6 million in my liability, it's going to be reduced by this principal amount that was applied to the liability. So I'm getting 4,707,178. Is that correct? Hello. Is that correct, guys? And then I think we need to do another 2 years because they're requesting for that. Did they ask for 2022? 21 and 23. Okay, so they skipped 2022, but we still have to do it. Guys, can you check that the math is correct, please? So this will be 470,718. Oh, that's not right. 1892,822. 18,92822 minus 470,718. Okay, 1,422,104. Really? Oh, I hate that. $3,285,074. Okay, can you guys see this now? Can you guys check my numbers? And this is 328,507. And then 18,92822 minus 328,507. Minus 32,85,074. So 1,720, 759. Okay, so does this look half right? I think it is. Okay, so we understand the lease payments are going to be the same. We could have done the fourth year as well and just show how it was paid off, like the complete amortization table. Maybe that makes more sense. So we can see that the lease payment remains the same. The interest is going to decrease as more is applied towards the principal amount, right? So the principal, the amount that's allocated to principal from this payment increases as the interest decreases, right? So we can see that allocation. And in number 3 and 4, they want us to prepare the entries for December 31st, 2021 and 2023. Now, since we have this asset in our balance sheet, we determined that this is a finance lease, then we're going to have to amortize this machine, and the useful life is 4 years. So we're going to take the 6 million divided by 4, and that will be our amortization expense, which will have to be made on December 31st. So we're going to have December 31st, 2021. And what are we going to debit and what are we going to credit? So on December 31st, 2021, in relationship to the lease payment, what do we debit and what do we credit? I don't know, in your place it's raining, but it's raining very hard here in Tamuning where I'm at. I can hardly hear myself. Okay, so we have interest expense. And you probably can't see this, right? Interest expense of 600,000, and we also going to decrease our payable by the amount that was allocated to principal, which is the 1,292,822, and we're gonna credit cash. And again, the cash being credited is always going to be the same. Okay, no matter what, it will be the same. So our December 31st entry related to this lease is going to look like this. And then in addition to that, we also have to do or record the amortization expense, which is the 6 million divided by 4, which I believe is 1.5. And so we debit amortization expense and we credit right of use asset for 1,500,000. Okay, so it looks like this. Everybody can see this? All right. So for December 2023, what are we going to do? What are we going to debit? What are we going to credit? Again, we're going to debit interest expense, right? For how much this time, since we're talking 2023? What's the amount of interest expense? $328,507, correct. And then again, a debit to a liability for the amount that was allocated to principal, the 1,564,315. And then again, a credit to cash for the same amount, 1,892,822. Okay, so here we go. And then once again, on 2023, we're going to have the same entry repeated at the end of every year, right? I'm just going to do it ditto. Yay, there we go. Same entry here for 2023, right? Any questions about this? I think if you have a lease that's classified as a finance lease from the lessee side, the entries, the calculations are going to be the same. The only items that might change, it will be when the payments are made. So payments might be made semi-annually, they might be made quarterly. Okay, so that's something that we need to pay attention to, because then we have to adjust our period and adjust our interest in order to find the correct factor. Okay. All right. So next one. On the next one, we have that on June 30th, Georgia Atlantic Inc. leased a warehouse equipment from IC Leasing Corporation. So again, we have the lessee side here. This is the lessee, this is the lessor. And I think there's another continuation to this where it is the lessor. So the lease agreement calls for Georgia Atlantic to make semi-annual lease payments. So here we're talking about semi-annual lease payments. They gave us the amount of the payments, so we don't have to calculate that. It is a 4-year lease term, payable each June 30 at the beginning, right? Because the lease is signed on June 30, and on June 30, I have to make a payment. So this is going to be an annuity due, right? Instead of at the end. So this is something that we need to pay attention to as we're working through these problems. Give me 1 minute, guys. I'll be right back.
You are now unmuted.
Okay, I'm back. All right. And so we were saying that this is the lessee. We have the lease payments. We have the lease term. And then we determine that the payments are due at the beginning. Okay. We have the fair value of the equipment is 3.5. Danielle, you have a question? Oh, okay. Now I just wondered. Okay. And so they want us to determine the present value of the lease payments, because remember that the amount that we're going to be recording is going to be the lowest of the fair market value or the present value of the lease payments. Okay, that's what we're going to be recording in our balance sheet. So in this case, did they give us a useful life for this asset? Amortization is recorded at the end of each fiscal year. Is its useful life 4 years also? This is a 4-year lease term. I guess so. Okay. All right. So determine the present value of the lease payments. And so to determine the present value of the lease payments, what we're going to do is we're going to take, these are semi-annual payments, right? So that means that we're going to have to convert our period. So the payments are 530,203, where n equals what? N equals 8, right? So it's 4 and then multiplied by 2 because it's semi-annual, so it's equal to 8. And I is equal to what? 6, right? So it's going to be our 12% divided by 2, which is equal to 6%. So if I come here to our present value of annuity due table, and I go to n equals 8 and I equals 6, then I'm here, right? On the 6.5824. So I'm gonna take the 530,203, multiply, this time we're multiplying because we're using the payments. In the previous one, we divided it because we were trying to figure out what the payments were, okay? Multiply by 6.5824. And I come up with, and you know, there might be a rounding difference here that may be different from maybe the solutions or anything or connect. So 3.490008, that's what I get. Okay, Danielle. Yeah, because of the rounding. So you're saying 3.489998. Yeah, because there's rounding. This one is rounding up. Okay. All right. And so this is the present value of our lease payments. This present value is lower, right? This present value is lower than the fair market value of 3.5 million. So we need to use the lower of the two when we are journalizing or adding this to our balance sheet. So we're going to have a journal entry on June 30 with this amount, right? So on June 30, June 30, 2021, we're going to debit the right of use asset for the 3.4, or can I make this smaller? So our right to use asset for 3,489,998, and then a credit to lease payable for 3,489,998. Okay, so note that I'm using the lowest of the two. I'm using the present value of the lease payments rather than the fair market value because it's lower. Okay. All right. So that will be our entry. Actually, we're missing one more entry because they made a payment at inception. So we have to report a debit to lease payable. It's going to be for the full amount of the payment. No interest is deducted because it's made on the day that we signed this contract, right? So all we're doing is just a simple entry. There is no interest. Does that make sense? Does it make sense as to why we are not recording any interest on this date? Guys, anyone? Thank you, thank you, thank you. All right. Okay, and so now we can start our beloved amortization table. Yay, amortization table. So much fun. Okay, and so we're going to start with our starting point for the amortization table. And are you going to have an amortization table for the exam? Of course, you're going to have an amortization table on the exam. Yes, definitely. Okay, date. We're not going to be spending time on this if you didn't needed it. And we have our lease payments. We have our interest expense, our decrease, and then the balance. Right? And disregard that number there. Actually, the number is here. Can you guys see any of this or not at all? So we said June 30, 21, lease payment of 530,203. There was no interest because no time lapsed. So it's whole decrease 203. And so the balance will be minus 530,203. Ah, 2,959,795. Yes. Can someone make sure that this is okay? All right. And then we come to the end of the year. This is our second payment. Again, the payments do not change. The payments are fixed, but we have to calculate the interest. So how do I calculate interest? Remember that this is semi-annual, right? So we're going to take our outstanding balance, the 2,959,795, and multiply it by what? What's the interest rate? The 6%, right? The 6%. So that will give us the amount of interest. I get 177,588. So this is gonna decrease my outstanding loan balance by 352,615. So my new balance is 29,59,795. 2,607,180. Okay. So that's not a period, that's a comma. So do we agree? Do we agree on this? Yes, we're good. Okay, so now we can do the journal entries. We already did the journal entries for June 30. So now we're going to do the journal entries for December 31st. So we're going to have it again, a debit to what? On December 31st, we're going to debit lease payable, yes. Lease payable of 352, 615. And what else? The interest expense of 177, 588. And then we're going to credit cash. Hopefully this adds up to the 530. 203. That doesn't change. Now we have a second entry because this is a finance lease. And our second entry is for what? Okay, the second entry is for amortization, correct? So amortization expense, the way that we're going to calculate this is we're going to take the 3,489,998. That's the amount that we recorded our right of use asset. And we're going to divide it by 4 years. However, the first year we acquired this lease, it was only for half year. So we're going to have to prorate that amortization from June 30 through December 31st. So we're going to have to divide that by 2, right? So we have 3,489,998 divided by 4, and then multiply by 1/2 or divided by 2. So I'm getting 436,250. 436,250. And then what do we credit? The right to use asset, yes. Of 436,250. Okay. So when it comes to December 31st, 2022, the amortization expense will be for the full amount. We're not going to divide it by 2. Okay. In this case, Danielle, yes, because we assumed they didn't actually tell us what the useful life of the asset is. They just told us what the term of the lease was. So we have to assume, I don't know, I can't read anything where it says that this is the useful life. So we have to assume that that is the amortization as well. Okay. Any questions about this? So this is pretty much the same as the previous one, except that it was for semi-annual payments, right? That was the only complexity added to this. Now, this is a continuation of what we just did